Imagine you wake up in early 2025, open the financial news, and suddenly realize that almost every story, soaring government interest, costs new capital controls, being debated, pension funds under stress, a major currency bloc talking openly about breaking from the dollar, feels less like a series of random events and more like chapters of a single story that's been unfolding for decades. That sensation of pattern, of something inevitable finally surfacing, is exactly what the fourth turning framework is about. It's not a trading system or a doomsday prophecy. It's a way of seeing history as a series of long financial and institutional life cycles, and 2025 as the moment when the current one stops being theoretical and becomes brutally real. The fourth turning theory, developed by William Strauss and Neil Howe, proposes that modern societies move through roughly 80-90-year cycles. Secula divided into four turnings. Each full cycle begins with a post-crisis rebuilding phase and ends with a new crisis. For the United States, you can trace the last three crisis periods quite cleanly: the American Revolution in the late 1700s, the Civil War in the mid-1800s, and the Great Depression World War II period in the 1930s and 1940s. Each of those was not just about politics or war. They were, at their core, massive financial restructurings. Debts were wiped out, currencies were redefined, taxation was reinvented, and the architecture of the economy was remade. Consider the 1930s, 1940s crisis. The stock market crash of 1929 shattered faith in unregulated markets, the banking system collapsed, and unemployment exploded. The response was not a tweak at the edges, it was a fundamental remaking. Creation of Social Security, federal deposit insurance, powerful central banking. Wartime finance. And after the war, a completely new global monetary order under Bretton Woods, centered on the dollar and U.S. gold. The first turning that followed, roughly the 1940s through early 1960s, was the era of rebuilding with that new framework in place. The shape of American capitalism for the next half-century was set in those years. According to Strauss and Howe, our current fourth turning began around the time of the global financial crisis in 2007-2008. The long boom that began after World War II and transformed into a leveraged, financialized, globalized order in the 1980s finally hit a wall. The subprime implosion, the collapse of Lehman Brothers, and the emergency interventions by the Federal Reserve and U.S. Treasury were not just a bad recession. They were the first convulsions of a systemic crisis. Too much debt relative to income, too much financial risk hidden in derivatives, and too much confidence that clever financial engineering had made crises obsolete. What followed, however, did not resolve the underlying problems. Central banks slashed interest rates to zero or near zero, bought trillions in bonds through quantitative easing, and verbally guaranteed markets that they would do whatever it takes. These measures stabilized the system in the short run, but they did so by adding more debt, inflating asset prices, and entrenching a belief that any downturn would be met with even more aggressive support. The cycle continued, only more fragile. Households that owned assets became wealthier, those without them fell behind, and inequality widened into a gulf that increasingly defined politics. From a fourth turning lens, the period from 2008 to the mid-2020s has been the build-up phase of the crisis rather than the climax. The tremors have been unmistakable. The Eurozone debt crisis, the rise of populist movements on both left and right, the extraordinary monetary experiments across the developed world, the explosion of corporate and sovereign debt, and then the pandemic shock in 2020 that triggered the fastest economic collapse and recovery in modern history. Each event revealed a system that could only be held together with larger and larger interventions. The key insight of the theory is that these crises are not random. They emerge when the institutions and financial arrangements built in the aftermath of the last great crisis finally become misaligned with the society they serve. Demographics shift, expectations change, global realities evolve, but the system's rules, tax codes, welfare states, monetary regimes, geopolitical commitments, stubbornly reflect an earlier world. Over time, tensions accumulate, promises made to retirees that cannot be financed, debt obligations that assume growth that never arrives, defense commitments that exceed resources, market valuations that price an eternal stability. Eventually, those tensions demand a reckoning. This is where 2025 comes in. If the fourth turning began around 2008, we are now nearly 2 decades into it. Historical analogs suggest that the most acute phase of a crisis, the period when the old order actually breaks and a new one is hammered out, tends to arrive in the latter third of the cycle. That would place the crest of the current crisis in the mid to late 2020s. But what makes 2025 especially significant is not simply its place in the abstract rhythm of history. It is the concrete financial calendar converging on that year. Debt maturities, policy expirations, demographic tipping points, and geopolitical realignments that force choices no longer deferrable. Think about how long the world has been running on the implicit assumption that the dollar will remain unchallenged, that interest rates can always be lowered, that government borrowing can always be rolled over cheaply, that asset prices will always recover after every dip. All of these assumptions depend on trust. Trust in institutions, in central banks, in political systems. Fourth turnings are the eras in which that trust is questioned, strained, and finally reset. The suspense lies in not knowing exactly what form that reset will take, only that the old pattern cannot continue indefinitely. By 2025, the financial and institutional contradictions of the post-World War II and post-1980s order are no longer a distant concern for academics and macro strategists. They are showing up in the daily lives of investors, workers, retirees, and governments. The theory suggests that in such a moment, societies are pushed to choose. Cling desperately to a faltering status quo and risk a more violent eventual break, or accept short-term pain to redesign the system. For markets, that is the turning of the screw. Valuations that assumed continuity suddenly must discount transformation. That is why, from a financial perspective, 2025 looks less like just another year, and more like the doorway into the final stage of a long-deferred reckoning. To see why 2025 is financially pivotal within this fourth turning, you have to trace the arc of the post-1980s economic model, the rise of deregulation, globalization, and above all, leverage. Beginning in the early 1980s, advanced economies shifted from an industrial growth model to a finance-driven one. Falling interest rates over 4 decades, from double digits in the early 1980s to near zero after 2008, allowed households, corporations, and governments to borrow ever more without immediately painful costs. Asset prices rose as discount rates fell, and paper wealth expanded faster than real productive capacity. A stark fact highlights the scale of this transformation. By the early 2020s, global debt, public and private combined, had reached over $300 trillion, more than 3 times global GDP, according to the Institute of International Finance. In the early 1980s, that ratio was roughly half of that. In other words, the world economy built an additional layer of claims, promises to pay in the future, on top of its productive base, on the assumption that future growth, low inflation, and low interest rates would make those promises sustainable. For decades, this appeared to work. Recessions were shorter and milder, inflation trended down, and headline living standards rose. But underneath the surface, 3 distortions were growing. First, financialization pulled capital away from long-term productive projects into shorter-term, higher leverage activities. Share buybacks, complex derivatives, and speculative real estate increasingly dominated capital allocation. Second, inequality soared as the owners of financial assets reaped the benefits of rising markets, while wages for median workers stagnated once adjusted for housing, healthcare, and education costs. Third, governments discovered they could promise more, tax cuts, spending programs, social benefits, without immediately raising taxes, because bond markets kept lending them money cheaply. The global financial crisis in 2007-2008 was a warning shot. The U.S. housing market, inflated by cheap credit and lax underwriting, cracked. Complex securities that had been rated as almost risk-free imploded. Major financial institutions teetered. The system revealed its vulnerability, a cascade of leverage built on top of assets whose value depended on continued confidence. In an earlier era, such a crisis might have forced a deep deleveraging and a reset of the financial architecture. Instead, central banks and governments intervened on an unprecedented scale, slashing rates, expanding their balance sheets, guaranteeing liabilities, and in some cases, directly recapitalizing banks. The key financial choice of that era, and the seed of today, as fourth turning climax, was to treat the crisis as a liquidity problem, not a solvency problem. Rather than allow widespread defaults and write-downs of bad debt, policymakers socialized much of the risk. Losses were spread over time through low interest rates, quantitative easing, and later, large fiscal deficits. This kept the machine running, but at the cost of even greater dependency on intervention. Markets learned a reflex. Whenever stress appeared, they expected central banks to step in. From 2009 through 2019, this pattern held. Interest rates in the United States, Europe, and Japan hovered near historic lows. Central bank balance sheets grew. Corporate debt issuance boomed as companies took advantage of cheap borrowing to refinance, buy back shares, and conduct mergers and acquisitions. Sovereign debt loads climbed, but as long as borrowing costs remained minimal, there was little urgency to address long-term sustainability. At the same time, the political fallout of the crisis, anger at bailouts, frustration over inequality, distrust of elites, fueled populist movements. Yet, structurally, the financial system remained the same, only more levered and more dependent on confidence. Then came the pandemic. In 2020, governments around the world shut down large swaths of economic activity. To prevent collapse, they deployed extraordinary fiscal and monetary stimulus. In the United States alone, trillions of dollars were injected through direct checks, expanded unemployment benefits, business support programs, and emergency lending facilities. Central banks cut rates back to zero and resumed or expanded quantitative easing. For a brief period, incomes were propped up even as output fell, and markets roared back in one of the fastest recoveries on record. But this time, the consequences were different. The combination of supply chain disruptions, massive fiscal stimulus, and ultra-loose monetary policy ignited inflation at levels not seen in advanced economies in 4 decades. By 2021-2022, U.S. consumer price inflation was running above 7 to 8% at its peak. Central banks faced a dilemma they had largely avoided since the early 1980s: continue supporting highly leveraged markets and governments, or restore price stability by tightening policy and risking financial turmoil. In 2022 and 2023, they chose tightening. The Federal Reserve raised its benchmark rate at the fastest pace since the Volcker era, eventually reaching above 5%. This was the moment the post-1980s model met its mathematical limits. For 40 years, the great disinflationary tide, globalization, cheap labor, technological deflation, had allowed ever more debt at ever lower rates. Once inflation returned, that equation flipped. The cost of servicing debt began to bite. Governments that had grown used to borrowing at 1 to 2% suddenly faced financing costs of 4 to 5% or more. Households with variable rate mortgages and corporations dependent on rolling over short-term debt saw their interest burdens jump. Asset valuations that had been justified by low discount rates looked stretched in a world of higher yields. By the early 2020s, the United States was running budget deficits of around 6.7% of GDP in peacetime, with federal debt exceeding 100% of GDP. Interest expense became one of the fastest growing items in the budget. Similar patterns emerged across many developed economies. Globally, the interest rate shock revealed who had been swimming naked. Highly leveraged real estate developers, overextended emerging markets, and fragile financial institutions began to wobble. Yet, even as inflation moderated from its peaks, it did not simply fall back to the pre-2020 norm. The comfortable world of low rates forever was gone. From a fourth turning perspective, this is exactly how late-stage crises feel. The toolkit that worked for decades begins to fail. Lowering rates or adding more debt no longer solves problems without creating bigger ones. Political constituencies polarize around incompatible demands: more social support and lower taxes, more security and less spending, more growth and less debt. Markets become more volatile because the underlying regime is in question. And the suspense heightens because it becomes clear that something fundamental must give, but nobody knows precisely when or how. This is the backdrop against which 2025 looms. The long wave of financialization, cheap money, and debt accumulation has reached its constraint. Central banks cannot easily go back to zero without risking another inflation spike, nor can they keep rates high indefinitely without destabilizing overleveraged sectors and governments. Politicians cannot easily promise both generous benefits and low taxes to aging populations without confronting bond markets. Investors can no longer assume that what worked from 1982 to 2020 will work in the 2020s and 2030s. The stage is set for a decisive phase, a final act of this fourth turning in which the core rules of the financial game are renegotiated rather than merely patched. What makes 2025 stand out in this unfolding drama is the convergence of structural pressures and very specific financial deadlines. The fourth turning framework points to a period when institutions must confront choices they have delayed for as long as possible. By 2025, many of those choices land on the calendar all at once. It is not that history cares about our calendar years, but that our policies, contracts, and promises are written around them, and those contracts are coming due. Start with government finances in the United States, still the anchor of the global system. The U.S. federal government has enjoyed the benefits of the 2017 Tax Cuts and Jobs Act, which reduced individual tax rates and changed corporate taxation. Many of the individual provisions of that law are scheduled to expire after 2025. That means that in 2025, policymakers face a stark decision: extend the cuts and add trillions more to projected deficits over the next decade. Let them expire and effectively raise taxes on a broad swath of households, or attempt a broader tax and spending reform. Each path has significant political costs and financial consequences. The can that was kicked down the road in 2017 lands firmly at the feet of the 2025 government. At the same time, the accumulated debt of the 2010s and early 2020s has to be rolled over at higher interest rates. U.S. Treasury securities with relatively low coupons issued in the last decade are maturing and being refinanced at current yields, which, even if they decline somewhat from 2023-2024, peaks are still much higher than the near-zero levels of the QE era. This creates what some analysts call a maturity wall across global sovereign and corporate balance sheets. a period in the mid-2020s when a large volume of debt must be refinanced in a materially different rate environment. The numbers are staggering. Trillions of dollars of corporate and sovereign bonds globally will be rolled over in the next few years. 2025 sits in the heart of that window. For pension systems, both public and private, the mid-2020s also represent an inflection point. The baby boomer generation is deep into retirement, drawing benefits from systems that were designed in a very different demographic era. In the United States, the Social Security Trust Fund is projected to face depletion in the next decade if no changes are made, but the early warning lights are already flashing. Benefit payouts exceed dedicated tax revenues, interest payments on trust fund holdings are under pressure from broader fiscal strains, and political polarization has stalled reforms. As more boomers retire and start drawing on pensions and healthcare programs, the underlying math tightens. 2025 is not the year of outright crisis, but it is squarely in the zone where markets start to question whether promises will be met in full and in real terms. Add to this the external side of the financial system. For decades, the dollar-aheist dominant global role has allowed the United States to borrow cheaply and run persistent deficits. In the 2010s and early 2020s, however, several large emerging economies, notably China and others in the so-called Global South, began experimenting with alternative payment systems, bilateral trade in local currencies, and modest diversification of reserves. Energy exporters explored pricing some contracts in non-dollar currencies. None of these, by themselves, dethrone the dollar, but taken together and combined with sanctions that have weaponized access to the dollar system, they introduce a creeping doubt. By 2025, the conversation around de-dollarization has shifted from fringe commentary to mainstream policy debate in many capitals. This doesn't mean the dollar collapses. It means that the assumption of effortless, permanent dollar hegemony is under review. Geopolitical tensions also intersect with financial fragility. The war in Ukraine, rising frictions in the South China Sea, and around Taiwan, and conflicts in the Middle East have already scrambled supply chains, reoriented defense spending, and heightened energy insecurity. Rearming, reshoring, and building redundancy all require capital. Yet they come at a time when debt burdens are already high and interest rates are less forgiving. Defense budgets compete with social spending and interest costs. Investors begin to price not just earnings and growth, but geopolitical risk premia in ways that had faded after the Cold War. A world that looks more like the 1930s in its fragmentation sits uneasily on a financial structure built for the relatively peaceful globalization of the 1990s and 2000s. The domestic political calendar amplifies this tension. In the United States, the outcome of the 2024 election sets the governing configuration for 2025. Whichever coalition is in power, it inherits an impossible trilemma. Maintain social promises, sustain a powerful global military and diplomatic footprint, and stabilize public debt, all without imposing intolerable pain on voters. Historically, such trilemmas are not resolved by clever technocratic compromise alone. They are resolved in crisis, under pressure from markets and events. That is the essence of a fourth turning climax. Decisions that elites could not or would not make voluntarily are forced upon them by circumstances. On the corporate side, the excesses of the zero-rate era also reached their reckoning phase around 2025. Companies that borrowed aggressively to buy back shares now face higher refinancing costs. Zombie firms, those that can barely cover interest with operating profits, struggle in a world where credit is scarcer and investors more cautious. Technology and venture capital, which boomed on the back of cheap money and growth at all costs models, must demonstrate real profitability. This doesn't merely threaten individual companies. It challenges an entire culture of capital allocation that assumed liquidity would always be abundant and free. Layered on top of all this is the silent pressure of demographics and productivity. Aging populations in advanced economies mean slower labor force growth and higher dependency ratios. Meanwhile, the promised productivity revolution from digital technologies has, so far, been modest at the macro level. The next wave, artificial intelligence and automation, could transform that, but the timing and distribution of gains are uncertain. If AI delivers rapid productivity gains, it could help grow out of some debt burdens, but it could also displace jobs, disrupt industries, and fuel social unrest. If it disappoints, then societies are left with high expectations, high debts, and modest growth. In either case, the 2025-2030 period becomes the proving ground. All of these threads tighten in 2020. Bonds must be rolled, tax and spending decisions must be made, populations continue to age, geopolitical fissures widen. Central banks either stay the course on tighter money, risking recession and market stress, or they pivot, risking a second wave of inflation. There is no painless path, only different configurations of pain and political backlash. In earlier decades, policymakers could delay. In the late 2020s, delay becomes harder because the feedback loops are shorter. Markets react faster, social media amplifies discontent, and global capital moves at the speed of light. This is why, in a generational sense, 2025 marks the beginning of the final stage of the fourth turning, rather than just another year of muddling through. The cumulative imbalances of the last 4 decades are no longer theoretical. They are colliding with cash flows, budgets, and ballots. Financial markets, which had faith that someone, central banks, technocrats, global institutions, would always find a way to smooth the cycle, are forced to reassess that belief. In the suspense of that reassessment lies the essence of a crisis climax, either a disorderly unraveling or a painful but ultimately constructive reset. If the years from 2008 to the early 2020s were the prelude and buildup of this fourth turning, then 2025 onward is where the narrative tightens and paths diverge. The financial question at the heart of this stage can be put simply: how will societies reconcile the promises embodied in their debts, entitlements, and asset valuations with the realities of their productive capacity, demographics, and political cohesion? The answer will define not just market returns, but the very structure of money and credit for a generation. One possible path is a prolonged inflationary resolution. In this scenario, policymakers, facing the political impossibility of explicit defaults or dramatic cuts in benefits, quietly choose to erode the real value of obligations through persistent, moderate inflation. Nominal promises are kept, but the purchasing power they represent declines faster than official statistics might suggest. Governments run primary deficits. Central banks maintain nominally positive but still accommodative real interest rates, and financial repression, regulations that force savings into government bonds and controlled banking channels, becomes more common. Savers, especially those holding cash and fixed income assets, bear much of the cost. Debtors, including highly indebted states, gain relief over time. Another path is a deflationary or disorderly deleveraging. Here, attempts to fight inflation with tight monetary policy in an already fragile system trigger cascading defaults. Over-levered corporations fail, housing markets correct sharply, and financial institutions under stress tighten credit even further. Asset prices fall significantly, unemployment rises, and political pressures mount. In such an environment, the promises embodied in debts are broken openly through bankruptcy, restructuring, and losses to bondholders and shareholders. Governments might be forced into austerity, cutting programs and raising taxes into a downturn, which deepens social unrest but purges the system more quickly. A third, more hybrid path involves explicit restructuring and regime change. Governments acknowledge that certain obligations, such as pension formulas or healthcare promises, cannot be met as currently written and move to renegotiate them. Taxes are overhauled, perhaps with wealth taxes, consumption taxes, or changes to capital gains treatment. Monetary regimes might also shift, adopting new rules for central banks, moving toward digital currencies, or even altering the role of gold or other reserves. Internationally, new agreements about trade, capital flows, and reserve currencies could emerge. This path is politically wrenching, but has the virtue of transparency. The reset is recognized as such. The suspense is that none of these paths can be followed in pure form. Reality will likely involve elements of all three, with the mix varying by country and over time. Yet the choices made in the 2025-2030 window will heavily influence which elements dominate. A decision to prioritize low unemployment and social stability, for instance, may tilt toward inflationary policies and financial repression, especially if debt burdens are high. A decision to defend the currency, guess credibility at all costs, may tilt toward tighter policy and higher short-term pain. Markets, in turn, will attempt to anticipate and front-run these choices, amplifying volatility. Technology sits in the middle of this resolution process as both wildcard and accelerant. The rapid advance of AI and automation has the potential to significantly boost productivity, lower costs, and create new industries, which could ease some debt burdens by expanding the economic pie. But it also threatens existing employment structures and income distributions. If AI is deployed largely to cut labor costs without broad sharing of gains, it can exacerbate inequality and deepen political division, undermining the social cohesion needed for any orderly financial restructuring. Conversely, if it becomes the backbone of new industries and services that are widely accessible, it could help rebuild a middle class and stabilize societies. The monetary system itself may evolve quickly in this period. Central bank digital currencies, CBDCs, which have been in pilot phases in several countries, could be rolled out more widely as governments seek greater control over payments, tax collection, and the transmission of monetary policy. In a crisis, CBDCs offer authorities a powerful tool: the ability to airdrop money directly to citizens, impose targeted capital controls, or even set differentiated interest rates on different types of balances. For individuals and investors, this raises profound questions about privacy, financial autonomy, and the nature of cash. For states, it represents both an opportunity to manage crises more precisely and a temptation to overreach. On the international front, the late stage of a fourth turning often coincides with shifts in global power. The British Empire's financial dominance faded through the crises of the early 20th century, culminating in the handoff to the United States and the dollar after World War II. Today, the question is whether a similar transition, or at least a partial diffusion of financial power, will occur. China's economy, while facing serious demographic and structural challenges, remains large and central to global trade. Regional blocs may increasingly settle trade in their own currencies or baskets of currencies. A multipolar monetary world would look very different from the dollar-centric system that has shaped portfolios, reserves, and cross-border capital flows since 1945. In domestic politics, the mid to late 2020s are likely to see the emergence of more explicit debates about the social contract, what governments owe citizens, what citizens owe each other, and how burdens and opportunities are shared. These debates, though framed in cultural or ideological terms, are fundamentally financial. Who pays for past promises? Who benefits from future growth? In stable periods, such questions can be blurred through gradualism and incremental change. In a fourth turning climax, they surface in raw form, often around budgets, bailouts, and tax codes. Markets must then price not just earnings and rates, but the risk that major redistributions of wealth and power are on the table. By 2025, younger generations, millennials, and Gen Z have accumulated enough political, economic, and cultural heft to challenge the arrangements built by their predecessors. They carry high student debt loads, face expensive housing, and have lived through multiple systemic shocks in their formative years: 9/11, the global financial crisis, the pandemic, inflation. Their tolerance for business as usual in finance and politics is understandably low. As their influence rises, pressure increases for reforms in areas like student lending, housing policy, healthcare financing, and climate investment, each of which has large fiscal and financial implications. The market's role in this drama is paradoxical. On one hand, they are disciplining forces. Bond investors can punish fiscal profligacy, equity markets can withdraw capital from unproductive firms, and currency markets can signal loss of confidence in policies. On the other hand, markets are also amplifiers of panic and euphoria. In a period when the basic rules are being questioned, volatility tends to rise. Short-term rallies may alternate with sharp sell-offs as narratives shift from inflation is dead to inflation is structural, from soft landing to hard landing, from the dollar is unassailable to the dollar is in jeopardy, and back again. All this points to why the final stage of the fourth turning is not a single crash, but a process, a testing of institutions and arrangements until those that cannot adapt fail and are replaced. 2025 is pivotal because the buffers that once absorbed shocks, the room to cut rates, the capacity to borrow cheaply, the experience of generations that survived the last great crisis are largely used up. The remaining margins for error are thin. That does not guarantee disaster, but it does heighten the stakes of every policy decision and market move. The deeper suspense is not about whether some form of reset is coming. That is almost baked in by the arithmetic of debt, demographics, and growth, but about its character. Will it be cooperative or conflictual? Will financial pain be shared broadly and transparently, or will it fall heaviest on those least able to bear it? Will technological gains be harnessed to rebuild resilience, or will they entrench oligarchies? These are not questions markets alone can answer, yet markets will react in real time as societies grope toward answers. Viewed from the long arc of history, one of the most important functions of a fourth turning is catharsis, bringing hidden contradictions into the open so they can be confronted. From a financial standpoint, this means acknowledging that the structures built in the aftermath of World War II, and then turbocharged since the 1980s, no longer fit the realities of the 2020s. That recognition is unsettling because so much of modern life depends on those structures. The expectation that pensions will be paid, that bank deposits are safe, that currencies retain value, that capital markets function smoothly. Yet history suggests that failing to adapt is ultimately more dangerous than enduring a difficult transition. By 2025, the process of catharsis is well underway. Inflation has already shaken belief in perpetual price stability. Rising interest costs have exposed the vulnerability of public finances once thought unassailable. Episodes of market stress, from regional banking tremors to sovereign debt scares, have revealed how quickly confidence can evaporate. At the same time, public debates about inequality, corporate power, housing affordability, and climate risk have moved into the financial mainstream. Terms like wealth tax, universal basic income, green bonds, and modern monetary theory are no longer niche. They are part of the policy toolkit under discussion. The key to understanding 2025 as the final stage of this turning is to see it not as an end, but as a pivot. The final stage is when the old order decisively loses its legitimacy, and the outlines of a new order begin to emerge, often in messy and contested ways. In financial terms, this could mean a shift from an era defined by maximal leverage, short-termism, and the primacy of shareholder value toward one that puts greater weight on solvency, resilience, and broader stakeholder claims. It might mean tighter constraints on speculative finance, new forms of public-private partnership for infrastructure and climate adaptation, and different norms for corporate governance and executive pay. The restructuring of public debt and entitlements is a central element of this pivot. For countries with high debt-to-GDP ratios and aging populations, 2025-2035 is the window in which they must decide how to make promises and capacity align. Some may opt for gradual inflation and subtle erosion of real benefits. Others may undertake explicit reforms, raising retirement ages, adjusting benefit formulas, redesigning healthcare systems, or implementing new tax regimes. Investors will watch closely to distinguish those who are confronting reality from those who are papering over it. Yield spreads, currency valuations, and capital flows will increasingly reflect judgments about credibility and adaptability, not just raw economic size. At the household level, generational shifts will play out in balance sheets. Baby boomers will continue transferring wealth to younger cohorts through inheritances and gifts, but the value of that wealth will be influenced by market performance and policy choices in this critical decade. Housing, in particular, sits at the intersection of asset values, debt, intergenerational equity, and social stability. If housing remains scarce and expensive due to zoning constraints, underbuilding, and speculative investment, younger generations may push more aggressively for reforms that directly target property markets, such as land value taxes, public housing investments, or tougher rules on speculative ownership. Such moves would have profound implications for one of the largest asset classes in the world. The corporate sector, too, will face a reevaluation of its social license. Companies that benefited enormously from globalization and financial engineering may be asked, through taxation, regulation, or social pressure, to contribute more to the stability of the system that enabled their rise. Those that align early with emerging priorities, resilience of supply chains, fair labor practices, climate risk mitigation, responsible use of AI, may find themselves favored not just by consumers, but by long-term investors and policymakers. Those that cling to purely extractive models may find access to capital constrained or their business models regulated out of viability. On the monetary front, the innovations and experiments of the 2020s will start to solidify into a new normal by the early 2030s. Whether that involves widespread use of CBDCs, greater role for regional currencies, partial backing of money by tangible assets, or simply a more rules-based approach to central banking, the point is that the improvisations of the crisis years give way to a more settled framework. The volatility and policy lurches of the fourth turning are replaced by codified norms, what future historians will call the post-crisis monetary regime. 2025 is significant not because that regime will be fully formed then, but because the negotiations, experiments, and failures that shape it will be in full swing. Crucially, none of this needs to imply apocalypse. Fourth turnings are dangerous, but they are also creative. The American system survived and ultimately strengthened through the Revolution, the Civil War, and the Depression, World War II crucibles, each time emerging with renewed institutions, broader inclusion, and more coherent financial arrangements. The pain was real and often horrific, but the long-term pattern was one of regeneration. The financial reset that accompanies such periods is brutal for those on the wrong side of it, but it also clears room for new entrepreneurs, new ideas, and new forms of capital formation. For individuals and institutions trying to navigate 2025 and beyond, the most important shift is mental. From assuming continuity to preparing for regime change. That does not mean predicting exact outcomes, which is impossible. It means recognizing that many of the relationships that held for the past 40 years, between stocks and bonds, between growth and inflation, between risk and return, between national politics and global finance, are likely to be unstable. It means paying closer attention to balance sheets, to real versus nominal values, to the political sustainability of policies, and to the resilience of income streams and business models under different macro scenarios. In this sense, the final stage language is less about a doomsday date and more about a phased transition. The years leading up to 2025 have been marked by denial, temporary fixes, and the belief that previous patterns will reassert themselves if we just wait. The years after 2025 are more likely to be defined by acceptance that the old patterns are gone, and by the difficult, often chaotic work of building new ones. Markets, always forward-looking, will move in anticipation of that acceptance, sometimes overshooting in pessimism or optimism, but gradually converging on whatever equilibrium emerges. Looking back a generation from now, it is likely that historians and financial analysts will treat the mid-2020s as a hinge point, much as we now see the early 1930s or late 1940s. They will note that certain policy choices, market crises, and institutional reforms around 2025 set the trajectory for decades. They will pay attention to how societies apportioned the costs of the reset, how they harnessed or mishandled new technologies, and how they balanced national interests with global interdependence. And they will see the fourth turning not as an abstract theory, but as a lived reality that reshaped balance sheets, careers, fortunes, and expectations. For now, standing inside the moment, the suspense is unresolved. We can see the pressures, measure the debts, model the demographics, and map the political fractures. We cannot yet see the exact form of the new order that will eventually replace the current one. That uncertainty is unnerving, but it is also the source of possibility. In the crucible of 2025's financial reckoning lies not only the risk of loss, but the chance to build systems that are more sustainable, more transparent, and more aligned with the world as it is, rather than the world of a vanished past. That, ultimately, is why 2025 marks the final stage of this fourth turning. It is the moment when history stops asking politely for change and starts demanding it.